Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Okay, welcome back. You know, the market usually moves in pretty predictable ways, right? Earnings reports, regular dividends, things you can almost set your watch by.
Yeah, there's a certain rhythm to it.
Exactly. But then, bam. Sometimes a company just drops this bombshell.
Yeah.
A massive one-off cash payment. A special dividend.
Ah, yes, the financial fireworks. They definitely grab headlines.
They really do. And we've got a bunch of sources here looking into these. So our mission today for you is basically to cut through the noise. What is a special dividend, really? Why would a company suddenly decide to do this instead of, say, buying back shares or making an acquisition?
Good questions.
And, crucially, how do you figure out if it's a sign of genuine strength, like we're crushing it? Or is it more of a warning sign? Like maybe they're running out of road. Okay, let's unpack this.
It's a fascinating area because, honestly, it forces management's hand. They have to reveal quite a bit about how they think about allocating capital. Are they focused on returning cash now, or are they playing a longer game? It's quite revealing.
So before we dive into the why, let's just quickly nail down the difference.
Right.
Regular dividends, those are the ones we expect, right? Like clockwork, maybe quarterly, maybe annually.
Absolutely. Steady, predictable. They signal consistent cash flow. That's the heartbeat, like you said.
Okay.
The special dividend, though, that completely breaks the pattern. It's a one-time thing, usually much bigger than the regular payment. And importantly, everyone knows it's not supposed to happen again next quarter.
So it's not part of the routine.
Not at all. It takes a specific decision by the board. Think of it less like a salary and more like a significant bonus, often triggered by something unusual, selling off a big part of the business, winning a huge lawsuit, that sort of thing.
Right. So the company suddenly has this mountain of cash. Why not use it to grow, buy a competitor, build a shiny new factory, pay down debt? Why just hand it back?
It almost feels like giving up on growth sometimes. Well, it can seem that way, but often it's framed as the peak of financial discipline. The sources we looked at point to basically four main reasons, and they all circle back to management being really honest about the future.
Okay, what's reason number one?
The simplest one is just excess cash. They've piled it up maybe from years of strong profits or, like we said, a windfall. They just have way more cash than they need for day-to-day operations or paying off debts.
But hang on. Even with tons of cash, couldn't a CEO always find something to invest in? Which I guess leads to the second reason. This is the tricky one, isn't it?
It really is. Reason number two, limited growth opportunities. This is where that whole discipline argument comes in strong.
Right.
If management looks around and genuinely can't find projects, internal investments, acquisitions that promise a really good return, better than their cost of capital.
Then just hoarding the cash is bad.
Exactly. Holding on to it and maybe spending it on mediocre projects just to look busy, that's often seen as destroying shareholder value, so returning it is considered the disciplined move.
Okay, I need help squaring this circle. Is returning cash a sign of maturity, like we're sensible? Or should the market be worried, thinking, uh-oh, they've hit a wall, no more big ideas?
That's the million-dollar question, isn't it? It really depends on the company and the context.
How so?
Well, if a giant, stable company like Microsoft does it, people tend to see it as discipline. They're protecting capital. But if a smaller, maybe high-growth tech company does it, the market might start to worry, like, have they lost their edge?
So you have to look at who is doing it and why they say they're doing it.
Absolutely. You scrutinize the press release, the CEO's comments. Are they talking about strategic focus, optimizing the balance sheet, good signs? Are they vague, just saying enhancing shareholder value without a clear plan? That could be a red flag.
Okay. What's the third reason then?
The third one is often about timing and external factors, tax or policy advantages. Sometimes companies try to get ahead of changes.
Like if taxes on dividends might go up.
Precisely. If there's talk of higher dividend taxes or capital gains taxes coming down the pipeline, management might rush a special dividend out the door so shareholders get the cash under the current better tax rules. It's basically a calculated move based on potential regulation.
Interesting. So the company acts like a tax planner for its shareholders in that moment.
In a way, yes. And finally, number four, signaling confidence. This is the big positive signal.
How does that work?
After maybe a run of fantastic earnings or a successful turnaround or selling off a division for a great price, the special dividend is like a victory lap. It shouts to the market, look how well we're doing. Our finances are so strong. Our future cash flow is so solid. We can give away this huge chunk of cash and still hit all our goals.
A bit of financial chest thumping.
You could say that, yeah.
Okay, it sounds good, but let's circle back to that potential downside. If they really can't find good ways to reinvest that cash internally, aren't they basically saying, you, the investor, can probably do better with this money than we can?
That is the critical caveat, yes. It can be a tacit admission from management that your opportunities for allocating that capital might actually be better than theirs at that specific moment.
Right. Okay, here's where it gets really interesting. Let's ground this in some real-world examples from the sources.
Yeah.
We've got 4 cases that really show this spectrum strength, discipline, maybe some warning signs. Let's start with the big one. Microsoft, back in 2004.
Oh yeah, Microsoft '04. That one's legendary in finance circles. They paid out $3 per share as a special dividend, total payout. Over $30 billion.
$30 billion. That's just staggering for the time.
It really was, almost unbelievable.
And the backstory matters there, right? It wasn't just magic money. It came from years of Windows and Office dominating, plus settling a major antitrust case, didn't it?
Exactly. It was accumulated profit and legal settlements. And analysts overwhelmingly saw this as pure strength. Discipline.
Why discipline?
Because Microsoft had this enormous pile of cash, far more than they needed for anything immediate. Instead of making maybe questionable acquisitions just to spend it, they returned a huge chunk to shareholders via the dividend and also a big share buyback program. It showed control, stability.
Makes sense. Now contrast that with a company that almost makes special dividends part of its character.
Yeah.
Costco.
Costco's a great case study in consistent discipline. They've done several large ones. Remember $7 per share in 2020.
I do.
And then an even bigger one, $15 per share just last year in 2023.
$15 on their stock price. That's substantial. What's the signal there? It feels different from Microsoft's one-off giant.
With Costco, it signals relentless operational efficiency. Their business model, all those membership fees, generates huge, reliable cash flows. So when analysts see these payouts, they think management is super disciplined about reinvestment.
Meaning they're not just chasing growth for growth's sake.
Exactly. They're not expanding recklessly or trying risky new things just because they have the cash. They're essentially saying, we made this extra cash. We don't have a high return use for it right now that meets our standards, so here you go. It reinforces their image of smart capital allocation.
Okay, so we've seen Microsoft's strength, Costco's discipline. Now let's look at where maybe things get a bit murky.
Yeah.
The sources mentioned ViacomCBS in 2004. Feels like a cautionary note is coming.
Yes, this one raises eyebrows. Viacom also did a special dividend in 2004, $5 per share. But the key detail, the one that made analysts nervous, was how they funded it.
How? Not just cash on hand.
Apparently not entirely. It was funded, at least in part, by taking on new debt. This was happening right before a bigger financial restructuring or recapitalization.
Well, hold on. They borrowed money to give it to shareholders. Why is that immediately risky?
Well, think about it. You're rewarding shareholders today, but you're doing it by increasing the company's debt load. That immediately bumps up leverage, the debt-to-equity ratio.
Which makes the company more vulnerable.
Precisely. Especially if the economy turns down. It also makes borrowing more expensive in the future. Debt holders and rating agencies look at that and get nervous. It increases the company's overall risk profile.
So analysts were thinking this wasn't strength, but maybe pressure? Like they had to do something for investors, even if it meant weakening the company long term.
That was the concern. Was it a sign they were struggling to find real growth opportunities internally? It's a stark contrast to Microsoft just returning cash it genuinely didn't need. This felt more like potentially sacrificing the future for the present.
Right. Moves it from discipline towards maybe desperation.
It certainly raises that question. Okay, one more case. Las Vegas Sands in 2012. This is interesting because casinos are such a cyclical business, right?
Yeah.
Very sensitive to the economy.
Absolutely. You'd think they'd hoard cash in good times.
You might think so. But in 2012, Las Vegas Sands declared a special dividend of $2.75 per share. And they tied it directly to strong results, particularly from their big operations in Macau and Singapore.
So in a volatile industry, what signal did that send?
Immense confidence. In an industry where cash flow can swing wildly, doing this told investors, our global diversification and operational strength are so solid, we can generate massive cash flow consistently, even with market ups and downs. We can afford this. It was a validation of their business model's resilience.
Okay, fascinating examples. So if we connect this to the bigger picture, For finance pros, for analysts, even for you as an investor trying to understand a company, these dividends aren't just news flashes. They're actual data points that change how you value the company.
Right, absolutely. Let's talk about how analysts integrate this. First off, in valuation models like a discounted cash flow or DCF model,
Yeah.
you have to treat these as extraordinary one-off events. You cannot just plug that big special dividend number into your spreadsheet and project it forward year after year.
Because it's not recurring.
Exactly. If you accidentally treated, say, Costco's $15 special dividend as if it were going to happen every year, you would wildly overestimate the company's value. So it gets stripped out of the regular cash flow projections.
Okay, so it's removed from the future forecast, but the fact that it happened still tells you something.
Precisely. Which brings us back to the leverage point. If it was debt financed, like that Viacom example,
Then it directly impacts the balance sheet ratios.
immediately your debt to equity ratio jumps. That can catch the eye of credit rating agencies, Moody's, S&P. A sudden spike in leverage, especially if it wasn't clearly explained by a massive acquisition or something, could trigger a review, maybe even a downgrade.
And just quickly, why should an average investor care if the company's credit rating slips a notch?
Because it costs them money. A lower credit rating means higher interest rates when the company borrows money in the future, refinancing old debt, taking out new loans for projects. That higher interest cost comes straight out of profits.
Profits that could have gone to you, the shareholder.
Exactly. So it increases the company's long-term risk just for that short-term payout gratification. This is why, internally, for a company's own strategy or corporate development teams, issuing a special dividend is a huge deal. They stress test everything. Big investors watch closely. Is this smart capital management, or are they just bowing to pressure?
So, wrapping this part up, the core lesson from all these sources seems to be special dividends are really a double-edged sword.
Couldn't have said it better.
They can shout, "We're strong, disciplined, flush with cash." Or they can whisper, "We might be running out of growth ideas and maybe we're taking on too much risk."
It really boils down to the ultimate trade-off analysis from management.
So what does this all mean for you listening? It means the next time a company makes headlines with a huge special dividend, don't just look at the dollar amount. You've got to dig deeper. Ask, where did this cash come from? Was it truly spare cash from amazing profits? Or did they borrow it?
Yeah, is management showing real discipline, or are they maybe signaling, even unintentionally, that the future looks a bit less bright for reinvestment?
So here's the final thought to chew on, building on what we've discussed. Since these special dividends basically reveal how management sees its own future, its ability to find great ways to reinvest capital.
Right, the landscape for high-return projects.
The big question you should ask yourself is this payout truly celebrating undeniable success right now, or away? Is it kind of a quiet admission that the company's running low on genuinely exciting ideas for the future, and maybe, just maybe, if best growth days are behind it?
Thinking about that different success versus running out of ideas, that's going to tell you a lot more about your investment than just the size of the dividend check itself.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.